This is a presentation on Boral Limited 2010 Annual Report. Boral Limited supplies and manufactures a wide range of building and construction materials in Australia, the United States and Asia. The company operates internationally through four main operating divisions including Boral Building Products, Boral Cement, Boral Construction Materials and Boral Construction related businesses. As you can see on the slide, this is a rough diagram to show the group structure. Boral Limited has many investments in subsidiaries, associates and jointly controlled entities all around the world. The consolidated profit after tax attributable to the shareholders of the parent entity for the 2010 financial year is at a loss of $96.1 million. Mark Selway was appointed as Boral's CEO on the 1st of January 2010. During the 2010 financial year end, Selway received a remuneration package to a total of $2.32 million. Accordingly, Selway's base salary shows an amount of approximately $1 million. It has also been apparent that Selway received short-term incentives of $1.1 million, being rewarded for achievement of key financial and non-financial performance objectives. Other benefits Selway have received includes parking and long service leave, which have amount to $17,000. Selway long-term incentive entitlements is 100% of fixed remuneration annually granted as options or share rights. In addition, there was an allocation of share-based payment of $173 million and superannuation of $7.2 million. The company's auditor for 2010 financial year is KPMG and the consolidated auditor's fee for the year is $1.8 million approximately. KPMG has also provided other assurance services including tax services. The total fee for all professional services at consolidated level are $1.78 million approximately. During the 2010 financial year, Boral as a parent entity has reported 103 controlled entities. 64 subsidiaries are located in Australia and 39 are foreign subsidiaries located mainly in 9 different countries including the United States of America, United Kingdom, Jersey, Netherlands, Germany, New Zealand, Singapore, Thailand and Indonesia. Due to economic downturn, 14 subsidiaries are in liquidation during the year. The report has presented 87 out of 89 sustaining subsidiaries are 100% owned by Boral Limited. The other 2 controlled entities are 90% and 89.47% owned by Boral Limited. There is no present evidence that Boral Limited has less than 50% ownership of any of the controlled entities. For the 2010 financial year, there are 14 investments in associates which total to around $294 million in value. Boral Limited have interest in jointly controlled operations and assets. Jointly controlled operations or jointly controlled assets involve the ventures combining their operations resources and expertise and jointly owning assets in order to manufacture, extract, create or build. A jointly controlled operation and jointly controlled assets is different from a jointly controlled entity because it does not involve the establishment of a corporation or other entity that is separate from the ventures themselves. It is common in practice to describe jointly controlled operation and jointly controlled assets as unincorporated joint ventures because of its absence of corporate structure. The interests of Boral Limited in unincorporated joint ventures and jointly controlled assets are brought into account by recognizing its financial statements, the asset it controls, the liability it incurs, the expense it incurs, and the shares of income it earns from the sale of goods or services by joint venture. In reference to Boral Limited, the entity presents to have interest in 14 jointly controlled operations and assets, as those business activities are conducted under joint venture arrangements, involving purchases and sales of products, dividends, and interest. The consolidated goodwill for the financial year 2010 is $275 million, and Boral identifies its CGU, which refers to cash generating units, according to the business type and country of operations for impairment test purpose. There is an impairment of goodwill in 2010 financial year, and this is about $4.3 million. Borrow has formed a tax consolidated group that's effective on 1st of July 2002 and operate as a parent entity for income tax purposes. Borrow has made the segment disclosure in Note 2 according to the management approach in AASB 8, under which operating segments are presented on the same basis as that used for the internal reports and is reviewed by the CEO. Borrow's accounting method used in its consolidations accounts for investment in subsidiaries, associates, jointly controlled entities, and interest in jointly controlled operations and assets are stated in Note 1 of significant accounting policies. It is noted that certain transactions between parents and subsidiaries are eliminated on consolidation. Firstly, it is important to understand subsidiaries are entities controlled by the parent entity, either directly or indirectly in governing its financial and operation policies, or through potential exercisable or convertible voting rights. In this case, the parent entity is Borrow Limited. According to AASB 127, consolidated and separate financial statements, investments in subsidiaries are included in consolidated accounts from the date when control commences until the date the control ceases. Intra-group transactions and balances and unrealized gains or losses arising from intra-group transactions are eliminated in the consolidated accounts. Significant influence over financial and operating policies is considered when identifying the associates for group for accounting and disclosure purposes. According to AASB 128, investment in associates, the share of the total recognized gains and losses of associates are included in the consolidated accounts based on equity accounting method, from the date when the significant influence commences until the date that ceases. It is noted that if the share of losses by the group exceeds the interest in an associate, the group's carrying amount is reduced to nil, and the recognition of further losses is discounted to the extent that legal or constructive obligations or payments are made by the group on behalf of the associate. In accordance with AASB 131, interest in joint ventures, the assets controlled by Borrow liabilities and expenses it incurs, its shares of income earned by sale of goods or services by the joint ventures are recognized on the consolidated accounts as interest in unincorporated joint ventures and jointly controlled assets. Any unrealized gains arising from transactions with associates and jointly controlled entities are eliminated to the extent of the group's interest in the entity. Unrealized losses arising from transactions with associates are eliminated in the same way as unrealized gains and are to the extent of which when there is no evidence of impairment. Starting on the 1st of July 2009, the group has adopted the following AASB interpretation. Now these includes AASB 3, business combinations, AASB 8 operating segments, AASB 101 presentation of financial statements, AASB 123 borrowing costs, AASB 127 consolidated and separate financial statements, AASB 128 investment in associates, and AASB 131 interest in joint ventures. According to the annual report, however, adoption of these standards has not resulted in any material change to the group's financial reports. The AASB has issued additional standards and interpretations that are effective for periods commencing after the date of the financial reports, which have not yet been adopted by the group. Thank you very much.